Welcome to this explainer. Today, we're diving straight into the hidden, complex machinery that literally dictates your financial future. It's this invisible system that almost every single one of us interacts with, yet very few actually understand how the decisions about our financial worth are calculated. Let's kick things off with a bit of a mystery, all right? Imagine two people walking into a bank asking for the exact same £20,000 personal loan. They have identical incomes, they have similar jobs, everything looks the same. Yet borrower A is offered a fantastic, low interest rate, while borrower B is slapped with a massively expensive rate or even rejected entirely. And the craziest part? Neither of them knows exactly why. So what gives? Why did one get rejected? It brings us to the absolute core question of our investigation today. How does the lender actually know who is riskier when both applicants look so incredibly similar on paper? Section 1. Beyond the credit score, peeling back the layers of approval. Most folks think the credit score is the whole shebang, but actually, that's just the very beginning. The process builds through 4 distinct layers. Layer 1 is just your raw credit history. Layer 2 is your credit score, which basically turns that history into a neat little number. But Layer 3? That is the lender's underwriting model, where banks inject their own highly guarded internal risk assessments. And finally, Layer 4 is pricing. Because the system isn't just asking if you get the loan, it's constantly calculating exactly what price you're going to get it at. So even if 2 people are approved, they would walk away with totally different terms. So what exactly is going on in that hidden third layer? Well, behind the scenes, lenders use a systematic process called underwriting. Think about it. If a bank receives hundreds of applications, it can't just look at someone and ask if they seem trustworthy, right? Instead, they feed massive amounts of past data into statistical models to estimate if a borrower with your exact characteristics will repay the loan. Basically, they're hunting for historical patterns to estimate your future risk. Section 2. When the models fail, the limits of mathematical assumptions. There's this really famous saying in finance: models don't predict the future. They estimate it based on assumptions about the future. And wow, the 2008 financial crisis is a textbook example of exactly this. Back then, institutions were using these incredibly sophisticated models to evaluate mortgage risk. But when the housing market turned, those complex mortgage models failed spectacularly. Why? Because they relied on totally flawed assumptions, like the idea that housing prices would literally just keep rising forever, and they severely underestimated the real risk at play. Section 3. Algorithms and your data. The rise of automated decisions. Now, we are way past the days of a local bank manager manually thumbing through your file from beginning to end. Today, credit decisions are handled by highly automated machine learning systems that process enormous amounts of information in an instant. But they often trigger what's known as the credit score paradox. It starts if you have no credit history. Because the machine has less info about you, it struggles to assess your risk. That leads to limited access to loans or just way higher costs. And the result? It becomes even harder to build the credit history you needed in the first place. It's this vicious cycle where the simple absence of information itself becomes a massive barrier. So we really have to step back and ask ourselves impartially, is the financial system genuinely measuring your true ability to repay? Or is it simply measuring how much financial history you already happen to have? Are these highly advanced systems actually evaluating risk, or are they just penalizing a lack of data? And relying on all this data gets incredibly messy when you look at the actual data problem. The entire financial system runs on data, but what happens if the automated system is fed the wrong information? Your file might be incomplete, or it could have outdated info, you could have incorrect balances or payments that were falsely reported as late. When the system that decides your financial future has the wrong information about you, the real-world consequences extend way, way beyond just a simple numerical error. Now, algorithms aren't inherently good or bad. Let's look at it objectively. On the upside, they offer incredible efficiency. They are faster, they're cheaper, and highly scalable, all while providing consistency by stripping out certain forms of human subjectivity. But the downside is steep. They raise incredibly serious questions about transparency and explainability. There's model risk, the ever-present danger of bad data, and real fair lending risks. Think about it. If an algorithm rejects you, can the lender even explain why? And more importantly, can you, the consumer, effectively challenge a computer's rejection? Section 4. The real human cost, more than just a data point. We absolutely have to bring this all back to Main Street because behind every single automated risk estimate, behind every sterile data point, is a real, breathing human being whose life is being impacted. A system's invisible decision to alter your interest rate by just a few percentage points isn't just a math exercise, it directly dictates your access to economic opportunity. To put that into perspective, it means thousands of real, hard-earned dollars out of your pocket over the life of a loan. A rejected application means missing out on buying a home, starting your dream business, handling a sudden emergency, or financing an education. The real-world consequences of these invisible decisions are just staggering. As we wrap up this explainer, I really want to leave you with a final thought to chew on. Who really decides who gets credit? Is it the human, the bank, the algorithm, or the data? Well, the reality is it's all of them working together in this giant puzzle. So moving forward, how do we ensure this unbelievably complex web of human policies and automated algorithms is truly measuring real risk, rather than just reproducing the hidden biases and mistakes buried inside the data? It's definitely something to think about the next time you tap apply. Thanks for joining me today, and keep asking the big questions.